In 2026, Wall Street is sending a very clear message. Confidence is not gone, it's just concentrated. While headlines talk about volatility, recession risks, and global tensions, institutional investors are quietly placing massive bets on just a few powerful sectors. Hedge funds, pension funds, and asset managers managing billions of dollars are not investing randomly. They are positioning strategically. And today, we're uncovering the truth behind Wall Street's confidence in 5 specific sectors. To understand this shift, you first need to understand how institutional investors think. Unlike retail traders reacting to daily news, Wall Street looks 12 to 24 months ahead. They study economic cycles, corporate earnings strength, structural demand trends, and policy signals from the Federal Reserve. Their goal isn't quick profits, it's durable growth with controlled risk. The first sector is artificial intelligence and advanced technology infrastructure. But this is not about hype or social media buzz. Institutional money is flowing into the backbone of AI. Semiconductor manufacturers, data center builders, cloud computing giants, and enterprise automation platforms. AI is no longer experimental. It's being integrated into logistics, healthcare diagnostics, finance, cybersecurity, and manufacturing. Corporations are spending billions upgrading infrastructure to stay competitive. Wall Street sees AI as a decade-long transformation, not a short-term trend. The second sector gaining confidence is energy, both traditional and next generation. Despite aggressive clean energy policies, global energy demand continues to rise. The United States remains a dominant oil and natural gas producer, especially in LNG exports. At the same time, battery storage, grid modernization, and nuclear innovation are accelerating. Wall Street understands something simple. The energy transition will take decades. During that transition, companies generating strong free cash flow from oil and gas, while also investing in renewables, are positioned for stability and profit. The third sector is healthcare and biotechnology. America's aging population creates predictable long-term demand. Healthcare spending in the US continues to grow, regardless of economic slowdowns. Pharmaceutical giants provide defensive stability, while biotech innovators offer high growth potential through gene therapies, precision medicine, and advanced treatments. Even in recessionary periods, healthcare demand doesn't disappear. The fourth sector is defense and aerospace. Geopolitical tensions and global instability have reshaped government spending priorities. The U.S. defense budget remains strong, and long-term military modernization programs provide steady revenue streams for contractors. Unlike consumer industries that fluctuate with spending habits, defense companies often operate under multi-year federal contracts. That predictability is attractive to institutional investors. In addition, satellite technology, cybersecurity defense, and private space initiatives are expanding the sector beyond traditional military equipment. Wall Street sees stability backed by government funding, and that builds confidence. The fifth sector is financial infrastructure and capital markets technology. After years of fintech disruption, major banks and exchanges have adapted aggressively. Digital payments, AI-driven credit models, and automated trading systems are improving efficiency across the financial system. Now here's the deeper truth behind all 5 sectors. Institutional confidence is built on 3 pillars: structural demand, pricing power, and policy alignment. Structural demand means these industries serve long-term needs, not temporary trends. Pricing power means leading companies can maintain strong margins even in uncertain times. And policy alignment means these sectors connect with national priorities. Wall Street's confidence isn't emotional, it's calculated. And when billions of dollars consistently flow toward the same sectors, it signals conviction about the future direction of the US economy. The real question is, are you watching where the smart money is going? Because in markets like this, understanding sector leadership could make the difference between average returns and strategic growth.